Right now, silver is crashing hard, charts are red, headlines are screaming panic. And if you hold physical silver, you're probably nervous, but here's the problem with that panic: the data doesn't match the story. Silver prices are collapsing, yet at the exact same time, physical silver is vanishing from the entire planet. That shouldn't be possible, and understanding why is the key to understanding what's really happening in this market. Let's break it down. In Economics 101, here's how normal markets work. When prices crash, supply increases, people panic sell, inventory piles up, more product becomes available. That's basic supply and demand. But right now, something completely different is happening. Silver prices are falling sharply, and simultaneously, physical silver is disappearing everywhere. Mints are suspending sales, dealers can't deliver orders, retailers are rationing purchases, vaults are being drained at record speed. Lower prices are not bringing more supply into the market. Instead, lower prices are triggering panic buying of physical metal, and that tells you immediately something in this market is fundamentally broken. Here's what we need to answer: if supply was actually increasing, where is it? Because the data says the opposite is happening, and this is crucial. There is not one silver market, there are two. And right now, they're telling completely different stories about what's happening. This is where most trading volume happens: futures contracts, derivatives, ETFs, digital silver, mostly traded by banks, hedge funds, and large institutions. Here's the thing about the paper market: it trades enormous volumes, far more silver than actually exists on the planet. And here's the truth most people don't want to admit: the vast majority of paper silver is never ever delivered. It's just financial exposure, it's a promise, it's a bet on price movement. This market can create supply with a computer keystroke. That's it. No physical metal needed. This is real metal. Coins you can hold, bars you can touch, kilograms that exist in the physical world. This market cannot fake supply, it cannot lie, and right now the physical market is screaming shortage. The paper market says silver is cheap, prices crashed, buy the dip. The physical market says sorry, we don't have any, mints are closed, dealers are rationing, vaults are empty. These two markets are telling opposite stories, and only one of them can be right. The question is which one? Let's look at some real evidence. The Perth Mint, one of the most respected bullion producers on earth, backed by the Australian government, trusted globally. Here's what happened: they didn't wait for the crash to occur. Before the major sell off even happened, they paused wholesale orders on major silver products. Their official reason: increasing global demand and a backlog of orders. Not declining demand, not excess inventory, a backlog. They even introduced monthly allocations. Let that phrase sink in. Monthly allocations, that's government rationing language. You use that language when you don't have enough product to go around. And remember, Australia is a major silver producing nation. They have access to domestic supply. If their own mint is rationing silver to their customers, that tells you everything about global supply right there. Now ask yourself this: if supply was already tight at higher prices, what happened after a 20% crash in prices? Demand exploded. Now let's talk about the US Mint. They did something dramatic. They suspended silver sales entirely. Their official explanation: price updates. But that's not what was really happening. What was really happening is this: prices moved so violently downward that they were selling silver below their replacement cost. They couldn't keep up. They were losing money on every ounce sold. So they paused. When sales resumed, prices jumped dramatically overnight. That wasn't inflation, that wasn't greed, that was repricing scarcity. Even after that repricing, you know what happened? Inventory didn't magically reappear. Instead, delays, sold out subscriptions, postponed releases. That is not how a functioning supply chain works. Now, this is where things get serious. India is one of the largest silver markets in the world, and right now, dealers aren't just low on inventory, they're defaulting. People are paying for silver and not receiving it. Orders are being accepted, money is being taken, metal is never delivered. That's not just inconvenient, that's a breakdown of trust in the system. When physical delivery fails, paper prices become meaningless, because a price is only real if the product is available at that price. Let's look at the Royal Mint in the United Kingdom. They're out of stock on basic silver bars. Costco is a bulk retailer. They're famous for selling massive volumes. Right now, Costco is limiting silver purchases per customer. Let that sink in. A bulk retailer is rationing silver. That doesn't happen unless demand is completely overwhelming supply. Now we get to the most important signal of all: China. Shanghai Futures Exchange vault data is showing something astonishing. In a single day, nearly 27 metric tons of silver were removed from those vaults. That's roughly 870,000 ounces gone in 24 hours. At that pace, those vaults could be completely drained in weeks. But here's what the mainstream media won't tell you: China has restricted silver exports. They've classified silver as a strategic national asset. They are actively pulling metal out of public vaults and they're moving it into private hands, into government reserves. Think about what's happening here. While the paper price crashes down, China is taking delivery. While Western markets are selling digital contracts, China is loading trucks with physical metal. That tells you exactly how serious this situation actually is. Now, watch this pattern carefully. Most of the selling happens during US trading hours. New York opens, the price dumps, selling happens. New York closes, the selling stops. Meanwhile, during Asian trading hours, silver stabilizes or the price rises. This is not random, this is not coincidence. The West is selling paper, the East is buying metal. One side is creating supply digitally, pressing keys on a keyboard. The other side is removing real silver from the system, from vaults, from the global supply. One side is playing with numbers, the other side is loading trucks. Which side do you think understands where true value actually is? Here's another signal that absolutely screams shortage. Silver lease rates, normally these stay near zero. Right now, they're exploding. Some reports show single digit spikes, others show extreme levels. High lease rates mean one very specific thing: no one wants to lend out their physical silver, not even temporarily, unless someone pays them a lot of money. And they're being paid heavily. That is not normal behavior. That is stress. That is a market showing signs of strain. When people won't even lend their metal at any price, it's because they don't want to give it up, because they know it's scarce. Silver has been in structural deficit for years. This is not new, this is not recent. Global demand consistently exceeds mine supply. Industrial demand is rising every single year: solar panels, batteries, electronics, electric vehicles, medical technology. Meanwhile, mine supply growth is flat, so there's a gap, a deficit. That gap has been filled by above ground stockpiles, vaults full of metal accumulated over decades. But here's what's happening now: those stockpiles are being drained, vaults are becoming emptier, buffers are disappearing. There is no slack left in the system. This crash didn't create the shortage problem, it exposed it. Let's be very clear about this. If you hold physical silver right now, do not let the paper price scare you into selling real metal. Look at the actual reality around you: mints shutting down production, deliveries failing, vaults being drained, lease rates spiking. You are holding something that the world cannot get enough of. The paper price dropping is noise. The physical metal disappearing is signal. Now, if you hold paper silver, you need to ask yourself a hard question. A very hard question. If everyone who owns paper silver demanded physical delivery right now, would the metal actually be there to deliver? Because promises only matter until they're tested. And we might be getting close to that test. Understand this: the paper price is not the real price. The real price is reflected in premiums, in what dealers actually charge over spot price. And the paradox is crystal clear: the lower the paper price goes, the faster physical silver disappears from the market. That's the exact opposite of how normal markets work. We've seen this before. When physical supply breaks in a market, paper eventually has to catch up. Not immediately, not smoothly, but inevitably. Paper markets can suppress prices temporarily. They do this with volume, with leverage, with derivatives, but paper markets cannot manufacture physical metal. Eventually, reality always wins. That's the pattern we see repeatedly in history. So, here's what matters: when that eventually happens, when the paper market is forced to price in the reality of physical shortage, the repricing is not gradual, it's violent. This silver crash is not a signal of weakness in the metal itself, it's a stress test of the entire system, and the physical market is failing that test spectacularly. The paper price fell dramatically, the physical metal vanished. One of those is an illusion, and it's definitely not the empty vaults. Stay calm, stay rational, understand how this game actually works, because the biggest financial mistakes are made when paper noise drowns out physical reality. I'm watching this situation closely and I'm keeping you updated with clear, direct analysis, no nonsense. If you found this breakdown valuable, please let me know in the comments. And if you want to see more deep analysis of what's actually happening in these markets, subscribe. I'll see you in the next one.